Now we're going to crossing over to our studios in Nairobi to get a view of what's happening in the Kenyan markets, and we do that with Steve Biko, director at Hildago Group. Steve, thank you so much for making the time to chat to us today. Of course, let's start off with your highlights of the day. Any market movements that stood out for you?
Today, precisely being first of the week, we've seen a significant improvement at the market. We've seen the 20-share index actually holding, key participation by foreign investors, and we've seen key movers like Safaricom, Kenya Commercial Bank, Equity actually taking control of the market, and this is a clear indication that the market is actually getting into a bullish mood as correction is already done, and looking at how the macroeconomic factors around the country are, the market is looking at settling into the year as December comes here in a very good bullish trend. So given how today has been, it's going to be a very interesting week for both foreign and local investors.
Looking at that bullish trend, Steve, of course, we see that the NSE is up almost by a fifth from last month. This seems to be, a very, very strong performance. Do you expect it to hold?
Yes. We need to understand that the market has actually been recovering. It's been a slow and painful journey for the NSE to recover, and I think the management, together with the central bank and the CMA and the National Treasury, have done what they must do to ensure that the economy is actually back on its feet, given the effects of the 2008 post-election violence. And given the fact that the market capitalization has hit the 1.8 trillion mark, it shows that the wealth, as a close of October, the wealth for all investors at the market stood at 100 billion plus. This is very significant in the sense that whichever way you look at it, the market is actually looking at a bullish trend. And given how key stocks are performing, and especially how today has been, this trend is actually going to hold. And if we do not hit 5,000 points at the end of this week, then we'll be looking at 5,000 points by end of next week.
Of course, we'll look out for those 5,000 points and whether they will be hit. But perhaps if we turn our focus over to some company news, of course, we saw Equity Bank posting a 7.2% growth in net income. Can you unpack some of those performances for us?
Equity has actually been able to employ a very keen and interesting strategy to be able to stay ahead of the pack, because it's the largest bank in terms of customer deposits in East Africa. And given its expansion into the region, given its diversification into key services and products, into merchant, investment banking, agency banking, and then a key focus on mobile applications, has seen the bank actually, lock in the lower end customers. But we've also seen that its focus on customer deposits, I've seen it stay ahead of the other banks. And given the fact that most banks are actually struggling to reduce their wage bill, Equity has maximized this through innovation to be able to stay ahead. But also, we need to understand that it's come together with key strategic partners who've helped it reduce its cost of operations in terms of convenience, ICT, and being looking at a way to be able to see how its top-end clients can be able to support its urge to be able to accommodate its the bottom of the pyramid kind of customers. So for Equity, the results are impressive, and this is a trend that's actually going to continue. However, it seems that most banks are actually now heading towards the same direction, innovation in the mobile sector. So, and it seems that everyone seems to have exhausted the M-Pesa application and how it can be related to various banks, products and services. So depending on how next quarter will be, will determine whether Equity will continue the same trend or its fortunes will start going south.
It definitely sounds like a trendsetter in its particular industry right now. But keeping with banks, we've also seen KCB almost come under negative news for laying off 120 staff members. This is a part of their restructuring plan. I'm sure investors are really happy about this because it brings down their wage bill. But has there been any public reaction to this decision?
Definitely. On one end, key investors and shareholders are very happy about this, because when you're looking at cost to net income ratio, KCB had the highest in its level of peer kind of banks. And with reducing, the plan was to reduce 1,000 workers. As of last year, they had 5,162 workers, and so far 162 have gone home. And of course, the public I mean, this reduction of jobs definitely has a negative perception. However, we need to understand that with KCB also taking a keen look at innovation, keen look at ICT, this definitely reduces its cost of operation, and the need for human capital or human resource is actually also reduced. So we are seeing a trend whereby banks are going to leverage ICT development of its products and services to be able to reduce cost of operations and especially the wage bill, so that at least they can be able to show up their profits, given that competition is actually tough, and the Kenyan customer is very picky, is very choosy, and the aspect for convenience and the aspect of what they need is actually gone up. So it's a tightrope for KCB, but it's actually done very well for them, because when you look at the results last week, they were pretty impressive, and it's one of the banks to watch in the coming quarter.
Of course, that's a tricky line to balance, that mandate to support the government in terms of job creation, whilst also trying to get ahead in amongst your competitors. But quickly, Steve, before I let you go, we're also seeing the sugar sector under threat in Kenya, with the COMESA safeguards likely not to be extended. What's your view on the impact a not granting of an extension might have on the sector?
Unfortunately, on this issue of the sugar industry in the country, I believe the government has let down the farmers, because we've always extended, the need for the country not to participate or to actually come under the guidelines for COMESA. And even as the deadline comes to an end, I've seen actually a paper requesting more extension, because no single factory in the country is actually ready for the competition. No single factory is actually applying any international standards in terms of manufacturing of the sugar products. And we've seen the listed stock that is in the industry movement is actually diversifying into areas that actually do not pertain to its core mandate or its core business. So we're seeing that if the guidelines come into force, the sugar industry is actually going to collapse. His Excellency the President has promised yesterday, when he visited the region, the key region that produces sugar, Western, that he's going to personally handle the sugar matters. However, this doesn't really augur well, because we need institutions can be able to play on the international level, because administrations and regimes change, and we need institutions that can be able to understand the farmers' need, understand the financial aspect, and be able to diversify within the core mandate of what sugar production is all about. Unfortunately, unless the Ministry of Agriculture does something about this in conjunction with Central Bank and other key stakeholders, if the COMESA guidelines come into play, the sugar industry is going to crash. But let's wait and see what the president actually has up his sleeve, because he did promise to do something for the farmers. The government has released 800 million to the key factories to be able to pay off their debts and see whether this can be able to jumpstart the ailing industry.